All right, today we're tearing apart a top-tier institutional report to really understand the massive hidden risks that are lurking just beneath the surface of today's market, which, let's be honest, feels deceptively calm.
Okay, let's just jump right into the heart of it. This one quote from the report is the central puzzle we're trying to solve today. On the one hand, you have this strange sense of calm, of relief, but the report calls it a brinkmanship equilibrium. It's a fancy term for a very dangerous balancing act, where the real economy is basically screaming for help.
And this is the key question, right? It feels like the market is just defying gravity. So by digging into the evidence that this report lays out, we're going to find out exactly what invisible forces are at play here.
Let's start digging for clues. And our first one? It's a biggie. It reveals this massive and frankly growing disconnect between the optimism you see on Wall Street and the actual pain happening on Main Street.
I mean, just look at this chart. The collapse in consumer confidence is nothing short of dramatic. The TIP Economic Optimism Index has absolutely plunged to 42.8. We haven't seen a level that low in nearly 2 years. This isn't just some small dip, This is a flashing red light signaling serious economic stress.
And it gets even more telling when you look under the hood. People's 6-month outlook has cratered by over 10%. And why is that? Well, it's because their expectations for inflation over the next year have suddenly shot up. And it's almost all because of soaring gas prices. You see that historical correlation there, minus 0.67? That's just a fancy way of saying that when people feel pain at the pump, their confidence absolutely tanks. The report calls this a classic, textbook sign of potential stagflation.
So, you've got to ask, how is the Federal Reserve responding to all this? Well, frankly, they seem paralyzed. On one side, you've got John Williams at the New York Fed saying, don't worry, everything is well positioned. But then on the other side, you've got officials like Goolsbee and Haymack openly talking about more rate hikes if inflation doesn't back down. This split shows you they're completely trapped between a slowing economy and prices that are just stubbornly high.
Okay, now for our second clue. This one takes us deep into the hidden plumbing of the financial system, where a quiet but absolutely massive drain of cash is happening right under everyone's noses.
Now, to understand what's going on, you only really need to know about 2 key accounts. First is the TGA, the Treasury General Account. Think of it as the government's checking account. When the balance in that account goes up, it acts like a giant vacuum cleaner, just sucking cash and liquidity right out of the banking system. Then you have the RRP, or Reverse Repo Facility. That's supposed to be the safety valve, an emergency cash buffer the system can tap into when things get tight.
And boom! This chart just lays the whole problem out, plain as day. The TGA balance has ballooned to almost $850 billion, pulling a huge amount of money out of the market. And at the exact same time, look what's happened to the RRP. It's completely collapsed.
Look at that number. Just $15.3 billion left. That emergency buffer, the financial system's main shock absorber, it's pretty much empty. Functionally depleted. The safety net is gone right at the moment we might need it the most.
So let's recap. The economy is showing major cracks, and the financial system's cash buffer is gone. This brings us to our third clue, which explains why the market seems so calm. It's because that calm isn't real strength. It's a fragile, artificial illusion created by high-speed trading computers. See, the market today is dominated by these things called zero-day-to-expiration options, or 0DTE for short. The best way to think about them is as high-speed, computerized bets that last for less than a single day. They now make up a staggering 70% of all options trading. And what they do is force automated systems to constantly buy and sell, creating this hall of mirrors effect where the market looks stable, but it's actually incredibly fragile.
All of these super fast bets have created what the report calls a massive $72 billion gamma wall located right at the S&P 7,000 level. This thing acts like a powerful magnet, pinning the market in this unnaturally tight range and completely masking all that underlying economic weakness we saw earlier.
And this is where it gets incredibly dangerous. This whole setup creates a trap-door scenario. On the surface, everything seems fine, everything's calm. But if one external shock, a bad inflation report, some geopolitical event, pushes the market below a key technical level, like 6520, all those automated selling programs are designed to kick in at the exact same time. The floor could just vanish, triggering a flash crash. So let's put the pieces together. We've got a weak economy, we've got disappearing liquidity, and we've got a market being propped up by algorithms. With all that laid out, the report points to one specific, overlooked area as the potential trigger for a full-blown crisis.
We're talking about the private credit market,
This is a shadowy, multi-trillion-dollar corner of the financial world, where huge, non-public loans are made to companies. It has absolutely exploded in size. But here's the thing, it's almost completely unregulated, and there's very little transparency. And here is the big warning. The report identifies a systemic run on this opaque market as its #1 black swan risk. Because these loans can't be sold easily, if investors get spooked and all rush for the exits at once, there's no way out. It's basically a bank run, but with no regulator there to step in and stop the bleeding. And this isn't just a theory. The first cracks are already appearing. A major fund, Blue Owl Capital, was recently forced to stop investors from pulling their money out because they just couldn't sell assets fast enough. The report calls this the canary in the coal mine. A full crisis here could freeze credit everywhere, starving even healthy companies of the cash they need to survive.
Okay, so after all of that, what does it all mean for the path forward? After laying out all the evidence, the report wraps up with a final verdict and two very distinct scenarios. The report's final judgment isn't bullish or bearish. They call it dangerous neutral. And what that really means is that the market isn't being held up by a strong economy. No, it's only being held up by those technical forces we just talked about, that gamma wall and all the dealer hedging. And that makes its stability incredibly fragile.
And here are the two paths forward, as defined by the report. The base case, the one they give a 50% probability, is the bearish one. If current peace talks fall apart and oil spikes to $130 a barrel, the market could see a really sharp drop, down to around $6,300. The better scenario is less likely, and it depends entirely on a permanent ceasefire and a big drop in oil prices.
The report leaves us with this powerful and, I think, really memorable idea. That lack of liquidity, that cash drain we saw, is creating a constant downward pull on the market, like gravity. And the market's current high valuations? Well, that's what will determine just how fast and how far it could fall once that trapdoor finally opens.
So what's the catalyst? What's the trigger? The report is crystal clear. The single most important number to watch is this Friday's CPI inflation report. It could be the final piece of the puzzle that forces the market to finally confront the ugly reality of the economy. And that wraps up our explainer of this fascinating report.